And hello and welcome to this webinar presented by the IFRS Foundation. I'm Bella Cheng, responsible for capacity building at the IFRS Foundation Beijing office, and I'm your host today. So first, some housekeeping information. We encourage you to ask questions in the Q&A window. And on the topic for today, which is using the GHG Protocol for climate-related disclosures, we may not be able to comment on all questions we get during the webinar today, and some questions might be outside the scope of the topic that we're discussing today. But I want the audience to know that we will consider all of them in our educational efforts, including future webinars and communications. This webinar is being recorded and will be available on the IFRS Knowledge Hub. Okay, and we have closed captioning enabled. You can turn it on in Zoom. Live closed captioning will not be 100% accurate, but we hope it helps with the accessibility of today's content. Another quick disclaimer. The information and topics discussed in the webinar do not constitute implementation guidance from the IFRS Foundation. Our topic for today's episode is GHG emissions disclosure. As you might already know, the ISSB standards, specifically IFRS S2, require companies to disclose information about their climate-related risks and opportunities. This includes those related to GHG emissions measured in accordance with the GHG Protocol corporate standard. Along with an overview of the GHG Protocol and the accounting for greenhouse gas emissions, we will look at some common challenges using the GHG Protocol with the IFRS S2 and the broader benefits to companies of GHG accounting beyond disclosure. Links to several resources will be added in the chat as we go along and will be sent to you in the follow-up email. We will also send out a copy of the slides. Okay, so welcome to everyone joining live from all around the world. Here's a look at demographics of the registrations for this webinar. Over 3,500 people from 139 jurisdictions, including sustainability officers and finance and reporting executives, members of the accountancy profession and academia, as well as consultants. Okay, now let's turn to who will be our speakers today to lead up the discussion in a moment. First, I'd like to welcome Jenny from ISSB, and Jenny is ISSB member since December 2022, previously led sustainability strategy and disclosures at Siemens. Thanks, Jenny, for joining today. And I want to welcome our guest speakers who will bring expertise from different perspectives. So now I'd like to introduce the other 4 speakers for today's webinar. The first one is Sarah from ICAEW, who is Climate Change Manager from ICAEW. Sarah sits within the sustainability team at ICAEW and is the technical lead on climate change. She drives the development of know-how to support members in tackling climate issues, whether that in a business or practice, and engage in policy work to drive meaningful government action. Sarah is also helping to deliver ICAEW's own internal net zero strategy by engaging with internal stakeholders and ensuring the Institute conforms with best practice. And the second speaker is Cheng Lin, who is head of Secretariat of Capacity Building Alliance of Sustainable Investment, which is CASI. And he is also director of Center for International Collaborations at the Institute of Finance and Sustainability. He's also head of Secretariat Beijing office for the Green Investment Principles for the Belt and Road. He has been leading the Global Green Finance Leadership Program, a platform for capacity building and knowledge sharing our green finance, working under the G20 Sustainable Finance Working Group and the Network for Greening the Financial System since 2017. And the third speaker is Wanyu Sung from CDP. She is the CDP's regional head of supply chain and reporter services, Greater China. In this role, she works with CDP's supply chain members headquartered in Greater China to implement their supplier engagement strategies, strengthening suppliers' capacity in environmental management and ultimately improve overall supply chain transparency through CDP disclosure cycle. And the last speaker is Caroline from Persefoni. Caroline is the Director, Head of Climate Solutions EMEA from Persefoni. Caroline is a seasoned sustainability professional with over 20 years of experience helping businesses navigate the complexities of environmental impact and decarbonization. Throughout her career, Caroline has collaborated with hundreds of organizations across various industries, guiding them in understanding their carbon footprint and implementing strategies to reduce emissions. A recognized expert in the GHG Protocol, Caroline specializes in supporting companies to use data to create actionable plans to decarbonize and move towards net zero goals. Thanks all for your contribution to the discussion today. So now let's start our discussion. The first question is for Jenny from ISSB. So the question is, from your perspective, how does quantifying and reporting emissions, what some may call GHG emissions accounting, benefit companies and investors? Over to you, Jenny.
Thank you, Bella. So the measurement of emissions is indeed an integral part of sustainability disclosures. And emission-related information disclosed in accordance with our ISSB standards will help investors to make decisions about providing resources to an entity. And just as financial accounting brings clarity on how well a company is doing regarding its financial position, its financial performance, and also cash flows, emissions disclosures provide the insights into the risks and opportunities companies face related to emissions, and including how well those risks and opportunities are being adapted and managed, and also how financial prospects are affected as a result. Many companies today are already measuring and reporting their greenhouse gas emissions across their value chain, covering both direct and also indirect emissions. This is exactly where our IFRS S2 becomes critical. So paragraph 29 AI of IFRS S2 requires companies to disclose their absolute gross greenhouse gas emissions by scope, scopes 1, 2, and 3, providing a comprehensive and also transparent view of emissions. To ensure now consistency and comparability, IFRS S2 also mandates the use of the Greenhouse Gas Protocol, including its corporate standard and corporate value chain accounting and reporting standard. By requiring this, IFRS S2 provides a common basis for measuring emissions. The standard also requires organizations to disclose the inputs, assumptions, and methodologies applied. This ensures that greenhouse gas disclosures are robust, reliable, and comparable, aligning sustainability reporting with financial reporting principles. So let me conclude that IFRS S2 therefore really enhances decision useful information for investors, financial professionals, and company boards. And I do believe that that supports better risk assessment, capital allocation, and also long-term business planning. Back to you, Bella.
Thank you. Thank you, Jenny, for your insightful remarks that have kicked off our discussion. Your input has effectively set the context, laying a solid groundwork for our in-depth exploration today. So I will turn now to our panel to provide inputs into using GHG protocol to prepare GHG emissions disclosures, with our panelists representing the different sides of the disclosure discussion. A reminder to our audience, after an initial round of comments, we would love to take your questions. So the first question is for Sarah from ICAEW. So in your words, what is the greenhouse gas protocol and how does it guide organizations in reporting their greenhouse gas emissions? Over to you, Sarah.
Thanks, Bella. So the Greenhouse Gas Protocol was developed by the World Resource Institute and the World Business Council for Sustainable Development and is the globally accepted greenhouse gas accounting standard. It provides a comprehensive framework for organizations, governments, and cities to track their climate impact. And the GHG protocol, it sets the standard on how to measure and manage emissions across scopes 1, 2, and 3, which I think Wanyu will discuss a bit further later. So similar to guiding principles of financial accounting and reporting, the GHG protocol does also have a set of guiding principles. And they are relevance, completeness, consistency, transparency, and accuracy to ensure robust and reliable emissions reporting. The protocol provides a standardized methodology and helps organizations really identify emission sources, manage them, and disclose transparently. And as Jenny already mentioned, it aligns with the IFRS S2 reporting standard for consistent, comparable, and investor-focused disclosures. So following the GHG protocol really can enhance that stakeholder trust and help organizations track emissions performance over time.
Thank you, Sarah, for presenting a clear overview of the GHG protocol. So in addition to Sarah's informative introduction, we've shared several relevant links in the chat box for your further reference. So now, having grasped the general picture, let's move on to discuss some of the details. So the next question is for Wanyu from CDP. As Sarah briefly touched upon maybe scopes 1, 2, and 3 emissions as defined by the GHG protocol, we are all eager to learn more. Could you please elaborate on these key aspects in detail and how do companies typically calculate their direct and indirect emissions across their value chain? Over to you, Wanyu.
Thank you, Bella. Indeed, so GHG protocol is a accounting framework to guide company to understand and quantifying and managing a greenhouse gas across their direct operation and value chain. And it's important to understand the concept of value chain here. So GHG protocol help company to manage the emission across the value chain. They divide the emission into 3 scopes. The first scope is direct emission from their own or controlled sources, such as fuel combustion on site. So this represents the emissions that company has most direct control to manage them. The second one is scope 2. They are indirect emissions from purchased electricity, heat, or steam used by the organization. So to manage scope 2, that means company may generally need to work with their electricity providers. So this is also some indirect emissions that company need to using their influencing power. The third one is scope 3. So scope 3 is usually the one that company would need to do some engagement. Scope 3 represent all other indirect emissions across the value chain, including both upstream, for example, suppliers activity, and downstream, for example, product use or waste categories. So managing scope 3 regionally requires a lot of partnership across our business partners and also engagement. And so right now there are a lot of discussion about how company can work with their value chain partner to collect data from scope 3 and eventually to manage those emissions and also those risks across their value chain.
Thanks, Wanyu, for introducing scope 1, 2, and 3 emissions under the GHG protocol. I think when a company begins to preparing for GHG emissions disclosure, a critical step is to clearly identify the entity scope. So this defines the boundaries for emissions reporting, ensuring accurate measurement and credible disclosure. So my next question is for Sarah. What are the 3 approaches established by the GHG protocol for determining organizational boundaries? So over to you, Sarah.
Thanks, Bella. This is really important and it's very much dependent on your organizational structure. So as mentioned, there's 3 approaches to determining your organizational boundaries. There's the equity share approach, the financial control approach, and the operational control approach. So under equity share, it's really around the company accounting for GHG emissions according to the share of equity in the operation. So really, what is their economic interest in that and the extent to which that company has rights over sort of risks and rewards flowing from their operations. The second is all focused on financial control, and that approach is whether a company considers it having financial control over all operations. So does it retain, again, majority of risks and rewards relating to the operations assets? And the third one is operational control. So whether the company has authority to implement and introduce operating policies. So it will account for emissions over, say, 100% of emissions if it covers all of the operations. So they're all slightly different, and it is very much dependent on that organization, and particularly if you're a big organizations with subsidiaries, depending on, there might be a different approach for each of those. So it's really important to determine that right at the start and then apply that consistently across all of your approach to managing scope 1, 2, and 3.
Thanks, Sarah, for your inputs. Yeah, the 3 approaches you mentioned, the control approach, including equity share approach, financial control approach, and also an operational control approach, is crucial when it comes to defining the scope. So I'd like to highlight here that IFRS S2 requires companies to align their GHG emissions reporting boundaries with their financial reporting boundaries. Aligning emissions reporting with financial statements enhance connectivity between sustainability-related disclosures and the financial reporting, ensuring comparability across reporting periods. This consistency allows investors to better understand how climate-related risks and opportunities connect to a company's financial position and performance over time. It also supports decision useful information by integrating emission data into financial planning, enabling more informed risk assessments and strategic decision making. Okay, so now let's return to the task of quantifying scope 1, 2, and 3 emissions, which is essential for accurately assessing an organization's greenhouse gas footprint and driving informed climate-related decision-making. So the next question is for Wanyu from CDP. What is the methodology for quantifying scope 1 and 2 GHG emissions using the GHG Protocol corporate standards? And how do activity data, emission factors, and the global warming potential contribute to calculating emissions in metric tons of carbon dioxide equivalent? Over to you, Wanyu.
Thank you, Bella. So Bella already hits that to calculate scope 1 and 2 emissions, there are 3 components that we have to capture first. So the first one is activity data. So Activity data usually refer to, for example, the energy use, the transportation, the waste management, or some relevant activity that would drive our emissions sources. So yes, company will need to build out a system to capture, to collect those activity data, and also the units as well. A second piece is emission factor. So emission factor is the GHG emitted per unit of activity. For example, the GO2 kilometer per liter, or the some factor that we can convert our field into the GHG emitted per unit. And usually the emission factor, we can collect those data from some national database, industry standards, or third-party sources. And the third piece is the global warming potential. And this is the figure that can help us to convert gases such as methane or nitrous oxides into CO2 equivalents based on their climate impacts. So we need to capture these three figures: activity data, emission factor, and global warming potential, and multiply them together to get the GHG emissions. This seems to be sounds like very simple process, but the art and science of GHG accounting is that we need to do it in a persistent, consistent way along the years. So the meaningful, consistent way to do our GHG emissions is to do our accounting every year. So we can have a base year and we can measure our progress, and we can set a target based on our emission trends. So it's very important for company to document the source of the activity data, what kind of assumption they did, and what are the emission factor they use. And this will help our company to make sure their calculation of GHG emission inventory can be comparable across the years.
Thanks, Wanyu, for your introduction of the formula and also your kind reminder and advice to quantify scope 1 and scope 2. I know, given your extensive experience with scope 3 at CDP, we'd like to turn our focus to scope 3. So here is another question for you. So as we all know that scope 3 emissions are often the most complex and challenging to measure due to their broad coverage across the value chain. So what are the categories of scope 3 emissions, and how can organizations effectively assess which categories are most material to their business? Over to you, Wanyu.
Thank you, Bella. Yes, in this, like in CDP, we see some company, they may be maybe within 1 or 2 years, they will be expert in scope 1 and 2 calculate of reporting, but for scope 3 usually would take like 5 to 6 years. So definitely it's a journey. But I want to introduce a very important concept for scope 3. So scope 3, they can break down into 15 categories. Both some of them are upstream value chain activity, and some of them are downstream activity. But first, for reporting, before reporting scope 3, we would ask GHG Protocol suggest company to do a relevance assessment, materiality assessment, because for all the 15 categories of scope 3 emissions, some of them may represent the big chunk of our scope 3 emission. For example, purchased goods or our product used. And some of them may not be so important, for example, business travel. So it's very important for us to spend time and resources managing the scope 3 category that is most impactful for us. So from GHG Protocol, also CDP and also IFRS standard is very important for company to do relevance assessments first to understand which category out of scope 3 is most important for us to manage. And there is one rule of thumb to understand which category is most important for us. First, we would need to decide this by the size or by the influence and stakeholder expectation, and also emission reduction potentials. So GHG Protocol also set aside this kind of principle to help company to understand how to set their priority when managing scope 3 emissions.
Wanyu, thanks for your guidance on assessment of scope 3 categories. Well, here is worth to highlight that in the context of IFRS S2, the categories that a company includes in its scope 3 greenhouse gas emissions measurement depends on its facts and the circumstances. So to determine the categories to be included in its scope 3 greenhouse gas emissions, a company must consider its entire value chain, both upstream and downstream. While a company is required to consider the relevance of all 15 categories, it may find that not all are applicable and thus exclude them from its scope 3 greenhouse gas emissions measurement. This assessment is subject to materiality. Yeah. Now, I know that sizing and disclosing scope 3 emissions is challenging, especially in emerging markets and the developing economies, which lacks resources. So I know Cheng Lin from CASI. I know you've led many capacity building activities in EMDs. So my question for you is, what are some of the key challenges that organizations in emerging markets and the developing economies face when using the greenhouse gas protocol for emissions disclosures? And how can these challenges be effectively addressed? Over to you, Cheng Lin.
Great. Thank you very much, Bella, for the invitation and also good question. So I'm Cheng Lin from the CASI, which is the Capacity Building Alliance of Sustainable Investment. And I just realized I'm the only male speaker, and also so surprised to see we almost have around 1,000 participants online. So hello, everyone. So back to your question. So challenges in using the GHG protocol. I think not only about the GHG protocol, I think not all of them really knows what GHG protocols means, and also it's an important protocol for carbon accounting. So specifically in the EMDEs, I think based on our experience in the past few months and years of building capacity, we realized there are at least 4 types of challenges that has been raised. So firstly, in doing the carbon accounting, actually, they would need a lot of data, especially the metadata and also data that used to support their calculations, especially in banks and the broader financial sector. Banks normally would complain that actually without the, let's say, data from their clients, especially from their downstream clients, it is almost impossible for them to have accurate data that they can use to disclose or maybe for other purposes. And I can even hear similar voices from regulators because they normally will follow guidance from regulators. If regulators are not really confident with the data, they probably will not ask or maybe go to next steps about doing data. And if not data is available, then they probably will not be comfortable doing anything else in sustainable finance or in risk management, especially in stress testing and similar things. And the second thing is really on lack of the technical capacity. So even though the protocol is there, but how to turn the technical parts or the protocols and also the asset level information into something usable, and also interpret that data into something on the balance sheet or in the sustainability reports or the ISSB reports in the future is going to be also a big challenge. So the technical capacity is limited. I think this is the case in most countries, including developed and developing countries. And back to a few years ago, when I was in the UK, I was in I think a few meetings, and I heard some also companies, big or small, also complain about this. And the third thing is related. So on technical part, then there's infrastructure part. So due to the lack of enough infrastructure, that's let's say generating the data or maybe used to create those data. It is challenging, and also the tools, the lack of tools and sufficiently systems can be used to collect, compile, and also to report this data. And lastly, about regulatory uncertainty. This is also related to what I just said, especially on the data availability issue. And in some cases, the worst scenario could be different regulatory agencies can come with different voices, which is misleading in some cases, including, let's say, mostly the financial regulators could be the central bank, the more like FCA, or the Ministry of Finance, or Security Commission, or something like that. So not all of them are on the same page about sustainability disclosure and also on the regulation in details. So in response to these different types of challenges, I think there are also something we can do to enhance sustainability disclosure. For example, the capacity building, what do we do today? And also what we have been doing in the past. Capacity is key. And also it's not only about to tell them what the GHG protocol is, it's really how to tell them how to use this GHG protocol. My own experience is that it's easy to tell what this is, but it's not easy to tell them how to use this. And including accounting, doing some mock data, actually, it's very, very useful. And some tutorials are necessary to make sure these people are really understanding and also knowing how to use these protocols. And second thing is some factors, especially when the data is not available. I mean, infrastructure level data is not available, and then you need to use some more like emission factors to calculate or estimate the emission data. That's important. And also that leads to some kind of confidence on the data quality. And then technical adoption. So there are already some, I think, tools or methodologies available, developed either in one jurisdictional economy or that has been already broadly used in many jurisdictions, but it has been never widely adopted. So I think this capacity building or risk awareness on some of the technologies is important. And the last part is about collaboration. And the collaboration can be related to the different stakeholders, or it can be also more like along the supply chain. And the supply chain, there are focal companies who are really important to getting the data and also to incentivize the reporting and also provision of the data. So in a nutshell, I think these challenges are very common in most jurisdictions, especially in emerging markets and developing economies. And some of the solutions can also be possible. So don't be too panic. I think that's the key word I want to say. Thank you.
Thank you, Cheng Lin, for your invaluable inputs. I know there must be a mountain of work to do in capacity building. So your work is a great foundation, and I look forward to our continued efforts in capacity building. So now we're still on the Scope 3 topic. The next question is for Caroline from Persefoni. How can organizations improve the accuracy and the reliability of Scope 3 GHG emissions? Additionally, what role does technology play in enhancing the efficiency and the scalability of carbon accounting process for businesses? Over to you, Caroline.
Thank you, Bella. Yeah, so as already touched upon with some of the other speakers, the IFRS S2 is really built upon the GHG Protocol, which already provides guidance on how to get the best data and some of the methodologies for the greatest accuracy and best practice. Something that's really encouraged there is that a focus on primary data really allows for that accuracy gain. And so where possible, capturing data from suppliers or directly from companies is a really great way to ensure accuracy. But certainly where that's not feasible or it's simply not going to be appropriate to collect, it is possible to use indirect data sources, but just making sure that you're fully transparent and clear on where those data sources come from, whether that's industry averages or proxy data, for example, and any kind of detail on the methodology. Now, technology is really a huge driver for efficiency here. It gives a vast opportunity for improvement in accuracy and also scalability. So firstly, that can really help customers, companies who maybe haven't done this before, and really having a framework to get started and have some guidance in where to focus and how to frame their analysis. But then secondly, and perhaps most importantly, one of the biggest challenges comes with that data collection, and technology can really help streamline data collection at scale and with a much more comprehensive coverage. So that's through bulk smart uploads, that's through integrations and automation, and then that allows for a really accurate calculation quickly and with far less errors that may be apparent. And that comes through a number of different approaches. There are anomaly detections, there are smart technologies that can identify errors in the data and formatting, and equally it also brings all that data together in a way that's very readily effectively visualized, so being able to identify insights very quickly and create those reporting outputs that you can then use and really save companies many hours of time just sort of trawling through that data and trying to understand what it means.
Yeah, thanks, Caroline. It's evident that the technology like carbon emission calculation systems play a crucial role. These systems streamline processes, as you said, from data collection to reporting, enabling companies to navigate carbon accounting more efficiently. So, Caroline, do you have some practical tips for improving the GHG emissions reporting process, particularly for Scope 3 emissions? And how can companies identify key emission sources across their value chain and engage with suppliers to enhance data accuracy and completeness? Over to you, Caroline.
Thank you. Yeah, absolutely. And I think some of this has been touched upon by some of the other speakers before me, but the first thing is really to focus on what you're trying to get out of the analysis. So making sure that you're focusing on decision useful information, and that you're focusing on sort of a high level assessment to start with, so you can really identify where you should be putting that focus. If this is entirely new to you, there are a lot of resources already available. There's a lot of free material online and in the market, and the IFRS Knowledge Hub is a really great place to start to use that. So, for example, we have provided emission sector emission profiles, so that if you aren't sure where in your sector is the highest sources of emissions and which categories to focus on, that can give a great starting point. Secondly, the supplier engagement is a really valuable step here. So it's a great way to really improve that data and that accuracy, and by identifying your suppliers that are the most material. So, for example, starting with a spend-based assessment, for example, that can help you to identify which suppliers are likely to have the greatest impact, and therefore which ones you can try and engage with. Making sure that you communicate in a really clear way is critical. The most successful supplier engagements that I've seen have involved companies that have really reached out and tried to provide supportive resources, education and training, and, for example, using supplier engagement webinars to get the process off the ground is a really great first step. And where we see perhaps less success is simply reaching out with data requests without actually encouraging the suppliers to understand why that data is useful and how it can be valuable to them. Again, there's a lot of free resource available, and technologies can really support with this. So, for example, Persefoni Pro, there's free calculation tools online where they can calculate their scope 1 to 3, but also it provides a really transparent and smooth process for data exchange that can be reutilized. And then lastly, making sure that you've got long-term consideration. So really look at incentivizing your suppliers and potentially incorporating carbon management into long-term partnerships.
Thank you, Caroline, for so many tips. And I hope all the audience can benefit from these practical tips. So let's come to the last question of the first round. We focus on in financial institutions. Knowing that Cheng Lin has extensive experience working with them, this one is for you. So what are financed emissions, and why are they important in the context of GHG accounting and the IFRS S2 disclosure requirements? Over to you, Cheng Lin.
Great, thank you. So thank you very much for that. I am also part of China Green Finance Committee, and which is a member or network of financial institutions who are managing or holding up to 75% of the total financial assets in China. I'm also leading some other research projects in collaboration with the banks and financial institutions in China. So 3 points maybe. Firstly, what is the finance emission? Apparently, the finance emission refers to the GHG emissions or greenhouse gas emissions associated or maybe generated with the entity's financial activities, such as the investments, loans, insurance underwriting, and asset management. Well, in some cases, especially insurance underwriting and maybe some other financial assets underwriting, there is also a concept called a facilitated emission, which is slightly different from the finance emission. But I think for bank loans, mostly we talk them as the finance emission. These emissions are mostly coming from the companies and projects these financial institutions are investing, or they are holding some assets related to these activities rather than their own operations. So the direct distinction is really between their own emission and operations and also their clients through the financial activities. So measuring these emissions is super important because of the 3 different stakeholders who are looking into this data. Firstly is the regulators. The regulators need to understand actually which banks are more exposed to the different risks. And of course, there are opportunities, which I think the second stakeholders, which are coming from the investors' point of view. And the IFRS, I think, has very clearly stated that the reports are mostly provided to the stakeholders in the financial market. And the third stakeholders for the readers who really want to see the data are coming from the other types of stakeholders, including researchers, NGOs, or even the college students and other types of financial market research. They also look into this data and compare which banks and also the communities they are looking into some of this information. So they are a very important part of the civil world. And then these organizations, how they actually do the carbon accounting, especially for the finance emissions. There is an organization which is also very close with us. It's called PCOF, Partnership for Carbon Accounting Financials. And they have developed some kind of a standard or maybe methodologies to help different types of financial institutions and assets to do the carbon accounting. For example, I'm a bank. I'm lending to one company or project. Well, this project is also borrowing from multiple banks or projects, other investors. So how to make sure these emissions through this project has been equally and sorry, not equally, maybe properly accounted to the right person is vital to make sure they are not over accounting, nor double counting, and so on. So no emission, no double counting, and things like that. So it's both a technical and also theoretical work. But in reality, these banks will have to disclose this information because for most banks, especially large banks, this finance emission could account for as many as 98 or even higher percentage of total emissions they hold. And if these banks do not disclose scope 3 or finance emission, then their own operations only counting for very, very low. And it doesn't make much sense, especially for finance institutions. Bella?
Thank you, Cheng Lin, for your inputs. And I'd like to add something regarding finance emissions. IFRS S2 requires financial institutions to disclose finance emissions, which is scope 3 and category 15, associated with the following industries, including asset management, commercial banking, and also insurance. So entities must report emissions separately for these categories, specifying their measurement methodology, allocation approach, and assumptions. Disclosures must ensure connectivity with financial reporting, including total assets under the management or loan exposure. If full disclosure is not possible, entities must explain exclusions and data limitations, enhancing transparency and comparability for investors. Okay, so thank you to all our panelists for those introductory comments. Let's now take questions from the audience. I can see many details of your live questions, but I already see the numbers. So so let me choose which is the lucky one. Okay. So the first question is for Sarah from ICAEW. Is about the reporting boundaries. So this one question asking that, can we choose a mixture of equity or operational, the mixture of methods or approach to defining the reporting boundaries. And once one is selected, it has to apply to all scopes.
So
Okay.
this depends. If you are say a group level, then you might choose one approach. If you're a large organization with lots of subsidiaries, then maybe each unit might be slightly different. Generally, I'd advise, yes, you should pick one and stick to it and apply to all, but it might be that you're a large organization that only has, say, 20% equity in one company, and therefore you wouldn't need to be measuring, like all of those emissions wouldn't be yours. It would be also accounting for the other organizations who have a share in that organization, if that makes sense. So for smaller organizations, it's probably a bit easier that you can identify. If you're larger, I'd advise having a sort of conversation at group level to really get into the weeds of how your operations work and then pick that approach. But at each sort of business unit level, yes, you should be applying that consistently. I hope that helps.
Thank you, Sarah, for providing answers. And I hope it helped with your questions. And I know there must be many difficulties when applying GHG protocol, especially for multinational organizations. Yeah, thanks, Sarah, for your inputs. And we have the second questions from our audience. This one is for Caroline from Persefoni. What is the best way of incorporating GHG protocol into the governance, risk, and the compliance automation platform? Over to you, Caroline.
Thank you. Yeah, I think there's, again, the GHG protocol, as touched upon, has a number of principles that align with it. So, looking at transparency and completeness, I think these are all really great principles to incorporate into general governance for the sustainability reporting. And when it comes to recognizing sort of how to focus on risks and making sure that you've got the appropriate steps in place, then absolutely recognizing kind of some of that transparency, identifying where the most materiality lies, and that can be across multiple stakeholders. It's important to remember the sort of direct impacts, but also both upstream and downstream, and recognizing sort of the impact that you may have both within your supply chain and your suppliers, but also to your customers and downstream of your activities.
Thanks, Caroline. Yeah, thanks very much for your comments and responses. Okay, now let's take a question for CDP. So this is for Wanyu from CDP. So one of our audience asked that I noticed that CDP supply chain allow firms to ask for key suppliers' GHG information, even at product level. However, how could we assess the credibility of these responses? For example, underreporting.
Yeah,
so Wanyu, over to you.
Yeah, I saw a lot of scolding question in the QA. So, but thank you for this one. I think I can answer this. So yes, so in CDP reporting, yes, we do ask company to if they are supplier to provide product levels, for example, their product footprint informations. And usually CDP just would also ask company if they can get more background info, for example, how they calculate that, and whether they have third-party verification documents. So if company can provide those evidence, for example, their accounting, how they the standard they use, methodology they use to calculate them, whether there's a trustworthy methodology, and whether they can provide verification documents, and also provide some basic info, for example, the scope, the boundary, something like that. So those parameters can help help our data user to judge the credibility of those data. Yes.
Yes, thanks, Wanyu. And this is also an opportunity to ask CDP about questions. I hope our audience today can benefit all of the questions and answers. Okay, so we just have last one question, and this question is for Jenny from ISSB. Jenny, I'd like to ask you what practical expedience and the transition reliefs does IFRS S2 offer for Scope 3 GHG emissions disclosures, and how should companies apply the principles of undue cost and effort and materiality in their reporting during the initial implementation phase? I think this is really important to all of us. So over to you, Jenny.
Yeah, absolutely, Bella. That's really a good and important question. And I hope that with my answer, I can also cover many of the questions that I've seen from the audience in the chat. So IFRS S2 recognizes indeed the complexity and challenges organizations face when disclosing Scope 3 greenhouse gas emissions. And therefore, to support these companies, particularly in their initial implementation, the standard provides several practical expedients and transition reliefs. So let me start. One key relief is that for the first annual reporting period, companies are not required to disclose Scope 3 greenhouse gas emissions. This also includes financed emissions for financial institutions, focusing instead on reporting Scope 1 and Scope 2. Additionally, while IFRS S2 requires companies to measure greenhouse gas emissions in accordance with the Greenhouse Gas Protocol, it permits entities to continue using a different methodology if they are required to do so by a jurisdictional authority or stock exchange. Another very critical principle in IFRS S2 is the use of reasonable and supportable information that is available at the reporting date without causing undue cost or effort. So what does that mean? This is not about exempting organizations from their disclosure responsibilities, but ensures they apply practical judgment. For instance, companies must carefully evaluate what data can be reasonably obtained within their value chain, even if that means relying on estimates or less precise data in the early stages. IFRS S2 requires entities to evaluate their entire value chain to determine relevant Scope 3 categories and apply the Scope 3 measurement framework outlined in paragraphs B40 to B54 in the appendix when making these determinations. Another important and key consideration is materiality. As outlined in IFRS S1, the materiality of information guides whether and how data should be disclosed. This requires companies to assess which Scope 3 categories are most significant to their business and their stakeholders. IFRS S2 requires companies to consider all 15 categories, but only disclose material ones. This targeted approach helps ensure that the reporting focuses on the information that truly matters while allowing flexibility during the transition. As you can see, these practical measures are designed to help organizations gradually build the necessary systems and processes for Scope 3 disclosures. It really is an iterative journey where companies can improve data quality and refine their methods over time, while maintaining transparency and accountability during the transition. Last but not least, worth mentioning, and also this was a question in the chat I saw, we of course acknowledge the recent updates to the Greenhouse Gas Protocol and will continue to follow up on developments in the harmonization landscape. And with that, Bella, I hand it back to you.
Thank you so much, Jenny, and thank you for all panelists for your inputs today. I want to remind everyone the last, let me share something for you, some resources that we can provide to you at the end. Okay. So I want to remind everyone that slides will be sent to all of you through email, and you can always connect with us by emailing us. And before we go, I would like to remind our listeners about some key resources to help you stay informed about developments. So the first one is IFRS Knowledge Hub, which have more than 200 resources from the IFRS Foundation and the third-party partners. And also we have the IFRS Sustainability Alliance, a membership program for education tools and the peer networking. And also we had our Fundamentals of Sustainability Accounting Credential, short for FSA, which institutes the link between sustainability and the financial performance. And finally, our website at ifrs.org, where you can sign up for alerts. So please remember that your use of our resources and participation in our programs also supports our mission as a nonprofit standard setter. Please stay involved with the IFRS Foundation, including through this webinar series. Follow our LinkedIn and the news updates to learn about more in the series, covering a variety of topics such as you can also listen to the ISSB monthly podcast to stay up to date. So finally, on behalf of the IFRS Foundation team, thank you for participating. And thank you and goodbye.